What's up everybody, it's your boy Shawn CPA coming back at you with another video. Today we're going to talk about the home mortgage interest deduction. Now this is actually a pretty common deduction. The reason I want to talk about it is because it's actually typically the largest deduction for most people on their taxes. So what is the deduction? Essentially you can deduct 100% of all the interest you paid on your primary residence home mortgage for the year on your taxes if you itemize. So this deduction will be reported on your Schedule A and is typically the largest deduction on the Schedule A for most people because most people's mortgage interest is actually kind of one of their biggest expenses. It's usually more than their healthcare costs and their state and local taxes and their charitable giving and stuff like that. So how do you even know how much home mortgage you paid in the first place for the year? Well, your lender who issued your mortgage and maintenances your mortgage loan, so the people you make payments to, they'll send you a form 1098 typically every January/February, which will list when you got your loan, how much was the original value, how much interest did you pay, and how much did you pay in points on the loan. And then that number is deductible. Now, the way it works is it's deductible up to the first $1 million of the mortgage if you bought your house before December 31st, 2017. But if you bought your house after December 31st, 2017, the interest up to the first $750,000 of the loan is deductible. And so are the points. The points will amortize over a certain number of years. A chunk of them will amortize every single year. So what that means is as long as your house, for most people, they don't need to look in too much to the details of the actual deduction, but I'll give it to you guys just so you know. The house has to be collateral for the loan, okay? It has to have like living quarters, a kitchen, like it has to be a livable area, but it can be like a condo, an apartment, a co-op space. Those qualify. It just has to be like actually livable and essentially your primary residence, and the points have to be for the mortgage, not for closing costs or anything like that or maintenance. Your homeowner's insurance, that kind of stuff is not deductible, okay? Just the mortgage interest, and that's what's reported on the 1098. If you have the form, it's really hard to go wrong. It's usually box one, the number. Let's say you pay $25,000 in mortgage interest and your loan is under $1 million, you're good to go. Like that. You can take that full deduction on your Schedule A, but you have to itemize. So if your mortgage interest deduction is under, let's say, $12,000, if you're a single person, or $24,000 if you're married filing jointly, you won't qualify to even take itemized deductions. So the home mortgage interest doesn't really apply in that situation. But usually for people, if they have a home, they itemize. The interest ends up being enough mixed in with their healthcare and donations and stuff like that. So that is the home mortgage interest and how you take it and how it works. If you have any questions, leave them in the comments below. I always answer my questions. Make sure you subscribe, hit thumbs up. And if you need help with your personal or business taxes, tax planning, and kind of business advisory services, definitely hit me up. You can book a call with me and my company, Neutron Tax, in the link in the description. I'll love to help you, and I'll catch you guys in the next video. Peace.